Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
So the IRS has just put a pretty big new deal on the table. And honestly, it could change how thousands of us think about handling past tax mistakes. We're going to break down exactly what this new proposal means for anyone looking to get back on track.
You know that nagging feeling you sometimes get about a past tax return? Maybe you missed something or forgot to report an account? Yeah, that's a really common anxiety, and it's exactly what this new IRS proposal is all about.
Because what's happening here is the IRS is looking to completely overhaul its long-standing program for people who want to come forward and, fix those past mistakes. So think of this as your guide to what's really on the table. All right, so what are we actually talking about here? What is this program? Well, the formal name for it is the Voluntary Disclosure Practice, or VDP. Let's dig into what that actually means.
At its heart, the VDP is basically a pathway for taxpayers to voluntarily come clean to the IRS. We're talking about things like unreported income, unfiled returns, that kind of stuff. Now, this program has been around for a while, but it's about to get a major facelift. So that brings us to the big question, right? Why now? Why is the IRS proposing all these changes? What are they trying to achieve with this? Well, according to the IRS, it really comes down to two main goals. On their end, they want to streamline what's become a pretty complicated internal process. But for us, for taxpayers, the goal is to turn what felt like a confusing maze into a really clear path, making it easier and, frankly, less mysterious for people to come forward on their own.
Okay, so if the IRS is offering this new deal, what does a taxpayer actually have to do to take it? Let's get into the nitty-gritty, the specific steps you'd have to follow. It really boils down to three core things. First, you have to file all the necessary paperwork. That means any returns you missed or any that need to be corrected. Second, and this is a big one, you've got to pay everything you owe, the tax itself, the interest, and any penalties. And finally, you have to sign the official closing agreements to make it all final. Now, you're probably wondering, how far back do you have to go with all this? Well, the proposal sets the standard disclosure period at 6 years. So generally speaking, you'll need to get the last 6 years of your financial life in order to qualify for the program.
And this is the single biggest reason people do this. This is the main incentive. The IRS states very clearly that taxpayers who follow all the rules will not be recommended for criminal prosecution. For anyone worried about really serious consequences, that is the core promise of this entire program.
But of course, this path isn't exactly free. There are still penalties involved. So let's look at the new penalty framework, which is a huge part of this proposal, because it's designed to make the whole process way more predictable.
The whole point of this new structure is to take the guesswork out of it. I mean, instead of this vague, kind of scary outcome, the IRS wants you to know exactly what financial penalties you'll be facing right from the get-go. No surprises. Think of this new framework like a clear menu of costs. If you've got late returns, standard failure to file penalties are what you'll face. For incorrect or amended returns, you're looking at a 20% accuracy-related penalty. And for more specific things like international info returns or foreign bank accounts, there are now clearly defined penalties. This just removes so much of that old uncertainty.
And here's a really key detail for anyone with late returns. Under this proposal, the IRS would apply the failure to file penalties, but they would waive the separate failure to pay penalties. It might sound small, but that's a really significant distinction that simplifies the final bill for the taxpayer.
So all this sounds pretty set in stone, right? Well, not quite. It's really important to remember that this is still just a proposal. So let's talk about the timeline for when these new rules might actually become official policy.
Okay, so here's how it's going to play out. The proposal was announced at the very end of 2025. Right now, there's a 90-day window for the public to submit comments, which closes in March of 2026. After that, the IRS is going to review all that feedback, and if things keep moving forward, we can probably expect the final rules to take effect sometime in late 2026.
This is a really critical question, though. Getting that conditional approval to even get into the program, that's just the first step. What happens if someone doesn't hold up their end of the bargain after they're in?
The consequences are, well, they're serious. The IRS can just revoke its approval. That means that shield from criminal prosecution, it's gone. The taxpayer could then be facing a full-blown examination with all the civil and criminal penalties back on the table. The stakes are definitely high.
So when you really boil it all down, that's the trade-off, isn't it?
The IRS is proposing a much more transparent and predictable way for people to fix their mistakes. It offers protection from the worst-case scenario, but it comes with a very clearly defined price tag in the form of these penalties.
And that really leaves us with this final thought. Is this new, streamlined program mainly a helping hand that the IRS is extending to taxpayers who are genuinely trying to do the right thing? Or, by making the process so clear and accessible, is it also a wider net, just designed to bring more people who've fallen out of compliance back into the system? It's definitely something to think about as this proposal gets closer to becoming policy.